Well, welcome everyone. My name is Michelle Taylor, and I'm here with my colleague, Dana Hastings. Both of us are advisors with Fairport and Luma Wealth, and we're really excited to have you all here today as we talk about our Wealth and Wellness series. Today's series is called Protection. It's one of four. Earlier this year, we had seminars that were on accumulation that talked about the phase of life where you're accumulating assets. We talked about utilization, which went over the different uses for taxes. And then we also went over distribution that talked about estate planning as well as preparing for retirement. And today's session, we're actually going to be talking about insurance. And I know that you all are probably thinking insurance, but we promise we'll try to make this as interesting as possible. And hopefully you'll have a nugget that you can take away with you and even ask some additional questions, whether that's with us or with one of your advisors. We actually will be covering a piece on Medicare as well as Social Security. It's going to be high level today, but we'd like to invite you to separate webinars that will be on September 21st or 23rd for the Medicare and October 7th for Social Security. So if you have an interest in that, check those out and certainly sign up. A couple of housekeeping items before we start. There is a question box that you'll see at the bottom of your screen. If you have any questions, please feel free to enter those, and we will do our best to answer those as we go throughout the presentation today. And lastly, we hope that you enjoyed today. And at this point, I'm actually going to turn it over to Dana Hastings to kick us off. Dana?
Hi, everyone. Happy almost Halloween, my favorite holiday of the year, just in case you were wondering. So today, we have 3 takeaways for you. First, we're going to show you why successful financial planning starts with your core values. Second, we're going to provide an overview of some of the most common types of insurance and give you important information about each type that may be helpful for your particular circumstances. We'll also discuss some things you may need to consider now as a result of the pandemic. And third, no matter what type of insurance it is, everyone's needs are different. There's so many things to consider. Let your wealth advisor help you make these decisions. At Fairport and Luma, remember, we don't sell insurance. We only provide insurance planning. Therefore, you know you're going to get advice that's centered around your values and your specific needs. I'm going to ask my big question of the day. Why is money important to you? Remember, money is just a means to an end. So I guess I'm asking, what's your why? While you type your answers in the question box, I'm going to share mine. Mine is financial security. My dad died at a fairly young age, leaving my mom to manage her finances for the first time in her entire life, along with several clueless teenagers. She made poor decisions. She did not have advisors in her life who really cared about her, and a few took advantage of her lack of understanding. Seeing what happened to my mom is why I do what I do. I don't ever want this to happen to others like her. In addition, financial security for my family is a huge driving force in my life. So, Michelle, would you please share what other people are saying?
Yeah, for those of you that would like to put in your answer, we'd love to hear. I do have a couple that have come back, and one is community, happiness, education, vacation, retirement, peace of mind. You know, that's a big one. I've seen that a lot too.
That's a great list, and thank you for sharing. Now, when we talk about financial security, community, family, education, those are our values. They're what truly motivate us from in here. Paying for college education, saving for retirement, traveling the world. Those are actually goals. What I've discovered over my 3+ years as an advisor is that goals are achieved most successfully when they're aligned with our core values. So knowing our values, what's really important to us, some of our most important goals may never be accomplished without it. We have too many things that are competing for our time and money. Our values help us prioritize what's important, what gets those resources. All right. Why are we spending so much time talking about values and goals? That's a fair question, if any of you are asking it. Let's start with a list of different types of insurance you may have to pay for during this life. Disability insurance, life insurance, renter's insurance, homeowner's insurance, automobile insurance, umbrella liability, long-term care. Just to name a few. What do you think when you hear this list? When most of us hear it, we think of the cost of having to pay for something we may never use. And often, that's what keeps people from buying the insurance that they really need. However, when we think about that list in terms of protecting people and values that are most important to us in this life, the cost is no longer the deciding factor. Now, let's jump into insurance. Michelle's going to get us started, and she's going to talk about health insurance. Before she does, I forgot to ask, are there any questions so far?
So far, it doesn't look like we have any questions, just the comments that we went over earlier.
Okay, great. And let's jump right in, Michelle.
Great. So before we actually start talking about all the different types of insurance and healthcare insurance, let's take a quick poll. I'd love to see what the audience has to say. So when we look at this, we're going to give you a few seconds here to talk about when was the last time you had an insurance review. Please select all that apply. The reason why we're asking this particular question is because it's really important that you actually do have an insurance review. And you might be able to find different ways that you can actually get either better coverage, or you can end up saving a little bit by just doing that review. So let's actually see what our audience said. So, actually, that's amazing. So some of you have actually reviewed in the last 1 to 3 years. That's the highest one. Fantastic. Love to hear that. So actually, if you would go to the next slide. Thanks. So a couple things that we want to talk about when we first talk about health insurance. We really want to make sure that we're crunching those numbers. And the reason is that when you first look at a traditional plan and you look at just a regular coverage, it's going to be the coverage that you probably had through an employer or that your spouse has actually had. And it's a traditional copay where you end up paying a certain amount every month. It's typically a little bit higher in premiums. However, when you go to see a doctor or go for that appointment, you're paying a smaller dollar amount for that appointment. So it might be $20 or it could be $50. But some of that can really add up over that year. And if you have a family, that could also get very, very costly. So let's actually take a look at a different type. And that's the high deductible plan paired with an HSA. And what that is you have an opportunity to pay less in monthly insurance each time you're each pay period. However, you also have an opportunity to put some money into something called an HSA or health savings account. What this account allows you to do is take pre-tax dollars, put that in to an account where you can then use that money to pay for any medical cost that you may have today, but also 20, 30, 40 years from now. As long as you use it for healthcare coverage, then there is no penalty and you do not pay tax on when you pull it out. Now, the downside to having a high deductible plan versus the traditional copay is, let's say I go to the doctor and at the beginning of the year and my doctor says, okay, your visit was $1,000. Well, instead of paying that $50 copay, I've got to pay $50 or $1,000 until I make it until I hit my deductible. However, your employer will most likely also give you money to help kickstart that account at the beginning of each year. So it's really important that you do run those numbers and you take a look to see which one really comes out, because I would bet in the long run, a lot of times you might find that that high deductible plan is a little bit better for you. Next slide. So let's talk a little bit more about the coverage. So what happens if you actually find yourself in transition and you are either going through a divorce, you could be entering into retirement, or maybe you even have a job change? What do? Well, if you find that you're going to have a gap in that coverage, one option is to look at COBRA. COBRA is typically utilized for people that have 20 employees or more. You can get it for up to 18 months. And basically, it keeps the same coverage that you've been used to. Same doctors, same type of care, coverage, what have you. Downside, price goes up, gets pretty expensive. The next option is to look at your state and see what your state might cover. This option is typically between 9 and 12 months. It can be used for employees under 20, but also in some cases over 20. And it is state specific. It's going to be more costly, but you are going to start to have some limitations. It'll be somewhat similar to COBRA, and just, again, shorter time frame than COBRA. The next one is Obamacare, or just going out to shop in the marketplace. Now, what you'll find here is that the costs are typically lower, but you don't have the same opportunity to use the same doctors. You may not have the same coverage. There could be some additional out-of-pocket expenses that you may have. So a lot of times, if you do that review, you'll find that COBRA is typically the better option. And then the last one is short-term or gap plans. And those are also just, you go out and you shop them. They're underwritten plans within the market. You typically will find a lot of limitations on those. Next, I want to briefly touch on Medicare. And when we look at Medicare, like we had mentioned, there's so much information on it. It's incredibly confusing at times. And you really want to be very careful when you're looking at these different types of plans. You're going to have plans that are with the, you'll hear like Medigap or the Medicare Advantage. When we look at those, the Medicare Supplement or the Medigap, it's typically a little more expensive. However, you typically will have better healthcare coverage in the long term. When you talk about the Medicare Advantage plans, you will end up hearing people say, oh, I could get on this great plan and I get a free gym membership, or it offers something else that your traditional Medigap does not. The problem with that is when you end up having a need for some really serious medical coverage, it's not as good. So make sure that you're really evaluating that, looking at the cost, finding what's comparable for you. Also, you want to look at all of the different parts of Part D, which is your prescription plan. And with that, you want to really do a review of that almost on an annual basis during open enrollment. Reason being is your prescription coverage will change, and the insurance companies may or may not cover that same prescription from year to year. So at one point you may have been paying $40 in retirement once you get onto your Medicare, and then next year, all of a sudden, if you kept that same plan, it's $500. So it could be a big difference. It's very important that you actually review it. You also need to be aware that your income levels in that given year will affect your premiums. So it's basically your modified adjusted gross income. It's going to affect how much you pay in Medicare from year to year. So if you find that in a given year as you're coming off, so let's say I'm retiring at the end of this year and starting Medicare next year, they are going to look back at my income from this previous year while I was working. Chances are I'm going to probably pay a higher premium in that year, and it's going to take me a year or two as my income starts to come down, and then I'll start to see some reduction in that monthly cost. Also, you want to make sure that when you are looking at all of the different plans, make sure that you're not only looking at what's covered, but you also want to find out what's not covered that might be specific to you. And what I mean by that is if you have a special need of some kind, so for example, maybe you're a diabetic, there might be certain coverages that you want to make sure that those plans have in place for that particular need. So lots of information. I'm going to pause for a second and see what questions we may have out there. Let's see. It says, I've always had a fear of looking for lower premium insurance of any kind, with the unfortunate result of lower level coverage when you need it. How best to make the comparison? I'll go ahead and take that one, and it looks like we have another one coming in too, Dana, and maybe we could share.
Okay.
So really, when you're looking at the different types of coverages, and I think Dana and I would both agree on this, if you're going out to review that and you're getting a comparison from an insurance company, if you have a third party advisor like us or someone else, you can actually ask them to do that review and comparison for you to give you an unbiased opinion. And I understand that because sometimes you just don't want to get locked into any additional insurance and not really understand it. It can be very complex. So I would say at any point that you can enlist a third party advisor to help you sort that out, do so. Another question, Dana. A couple who are receiving Medicare coverage, as a couple who are receiving Medicare coverage, we have a secondary coverage through STRS. I hear most folks having no copays or additional billing post-retirement. In our case, we have copays and get billed post-treatment. How do we investigate the best secondary supplemental coverage? Do you want me to take that or do you want to take that?
Go ahead.
Okay. So really what you want to do is there are a lot of different specialists out there that just handle Medicare. We could always refer you to a couple. We work with a few that are excellent. And I will tell you the best thing for them to do is to look at all of that. Let me give you an example. I have a very good friend that I referred out to one of our specialists that handles Medicare, and he's getting ready to go on their coverage. He was a fireman. And really, the advice that he gave was, because you are a fireman, there are certain restrictions or limitations that you have that if we put you on Medicare right now, you will be ineligible for some additional coverages. So I'm going to send you back to your company and start to look into that first. Call me with any questions. So as long as you find good people to help you look through it, they'll be able to give you the right information. And like I said, we're happy if you would like to reach out to us at any time. We can certainly help you with that referral.
I'll add to that is just make sure that you're working with somebody who's independent, can actually shop different coverages, take a look, wants to understand what STS has to offer, how it compares to other Medicare supplement type policies out there. So it's something that you definitely have to review in light of your particular circumstances.
For sure. And then it says, what if your employer only offers one plan and no HSA? So then unfortunately, you're going to have to go with that plan. But it's better than probably shopping it out on your own. All right. Thank you all so much for those questions. We are going to continue moving on. And I'm going to turn it over to Dana to talk more about property and casualty. Dana?
Okay. Property and casualty insurance is your homeowners, your automobile, your watercraft coverage. It's also some of these listed here. Some of these, there's some very specialized property and casualty insurance that we won't talk a lot about today. Just know the list is endless. It's insurance that helps you financially protect yourself against fire. You all know about that lately. Accident, lawsuit. We know what it is, but let's consider what are some important considerations. First, I would say consider increasing the deductible on your property and casualty policies to reduce the cost of your premium. Unlike years ago, it's actually kind of risky to submit too many claims on this type of coverage. In recent years, insurance companies act quickly to increase your premiums or even cancel your coverage when you submit too many claims. That's why a higher deductible makes sense. Michelle has a personal story that she can share with us.
Yeah, thanks, Dana. And the reason we want to bring this up is you just need to be aware that if you do make a claim, some consequences that could happen with that and how you may want to manage those. So from a personal standpoint, this happened years ago. We had a break-in to our garage. Our car was actually stolen because my husband left a valet key in there, but they filled the whole car up with our car seats, tools, anything that they could fit in the car, and they took off. So they did find the car, which was a good thing. However, it was still above and beyond really what our deductible was. I had never made a claim in the 20 years that I held this insurance. So I figured, well, this is what it's for. We might as well try to recoup some of the money that was lost. We had to buy, the car seats and a few other things that were necessity that we were using. So we make that claim. All goes well and good. Well, about 2.5 months later, we ended up having an issue where our basement flooded. They were doing some work on the roads, and all of a sudden it started filling up anytime it was raining. So we had to make another claim because our basement completely got destroyed. Everything in it had to be replaced and cleaned. And right before we were almost finished to lay the carpet back down, Hurricane Sandy hit. And I don't know if you all remember, but we were actually living also on the lake at that time. So with the perfect storm of Hurricane Sandy and the issues that we were having with the road work, even all of our neighbors ended up having trouble, and almost everybody on the street ended up having flooding back in their basement. So that was number 2 claim for the basement, 3 in total, in about a 4-month time frame. Guess what they did? They dropped us. So when we went to go shop to get coverage, we got literally nothing. Our only option was to go out and get basically the state insurance, what only covered the value of my purchase of my home, of the dwelling, nothing inside. And so it was pretty devastating, I would say, just because we were afraid that if anything else happened, if the house burnt down, other major issues, we would have been in a real predicament. So when you are looking at that, make sure that you're evaluating, is it worth to make the claim? If it's only a few $100s more than maybe you're over your deductible, you might want to rethink it. You just never know what's coming down the road. So thanks, Dana.
Thank you, Michelle. That's a pretty incredible story. It's actually scary. So my next point, always try to bundle your homeowner's automobile, umbrella liability. Always bundle those with the same company for additional premium discounts. And then you know that there are many differences between carriers and their contract provisions. So it's important to work with an agent that can compare multiple carriers and find the contract that has the provisions that meet your specific needs. I have a specific example. So we live in Bay Village, and many years ago when we first moved in, our basement flooded. My husband assured me that we had a very good homeowner's policy. So when our basement flooded, the insurance company immediately sent us a check for $5,000 to cover our losses. Here's what that flood cost us. First, we had to hire a water damage restoration service. Next, we had to replace carpeting, floors, walls throughout the entire basement, throw out all the furniture. Then we had to dig out all 4 sides of our home, waterproof, then replace all the landscaping and walkways. Significantly more than $5,000, right? Years later, when I decided to have a thorough property and casualty insurance review, I discovered there's actually companies out there who would pay damages up to $100,000. Now, I'm not sure that they would have covered all of that. I'm confident they probably would have covered more than $5,000. So even when contracts say that they provide replacement cost for your home, the specific terms vary from company to company. And even within the same insurance company, there's different levels of policy. So that's why, I'm a firm believer in working with an agent that is independent, can shop multiple companies and compare not only costs, but policy provisions. If you own high value items, you may need a personal articles insurance floater. You have that added to your homeowner's policy. It offers higher coverage limits above the limits provided in your base policy, which is usually like $1,000 to $2,500. This floater will cover things like furs, jewelry, firearms, camera equipment, golf equipment, art collections, china, silver, musical instruments, even personal computers. Due to the pandemic, some other considerations. Automobile carriers realize that people are driving a lot less. So they've been offering premium refunds. Have you received yours yet? You suddenly have additional household residents. Many college and adult children are moving back into our homes, causing many of us moms to drink more. It's just a joke. Make sure you contact your agent to add these new household members back onto your auto policy. Every permanent household member must be a listed driver. Make sure they're fully covered on your policy. Has anyone heard of personal cyber insurance? With the increase in home internet usage, as well as cybercrime at an all-time high, many insurance carriers provide personal cyber coverage to homeowner policies now at a very nominal cost. And then finally, many weddings, bar mitzvahs, and other large events have been canceled due to COVID. To avoid this loss in the future, families are adding special event insurance to cover potential cancellation of a future event. Now, next slide. How do we protect against, oh, at a poll, okay.
Oh, we can do the poll next.
Do we wait and do it? Oh yeah, okay, that's fine.
Yeah. Let's actually take a look and see what percent do you think a 20-year-old today has a chance of experiencing disability before age 67. So you might be surprised by this. So we'll give you all a few seconds to answer that. All right, let's go ahead and see what the poll says. All right, so 15%. That's funny, say 15%. 30% or 67, 30% of you said 67, 45% said 15, and then greater than 50, 11. So let's take a look at the actual poll. All right, next slide.
Okay, so this is back on property casualty, and we'll jump ahead to disability in a minute. This is what we call, this is talking about how we're going to protect ourselves against devastating liability claims. That's when we talk about personal excess liability, or what many of us call umbrella liability insurance. An umbrella liability insurance policy is that excess liability insurance that goes above liability limits on our homeowners, automobile, or watercraft coverage. It's one policy that acts like an umbrella over all of these coverages. It provides that extra layer of security in the event you're sued. It protects against damages to other people's property, injuries caused to others in an accident, libel, vandalism, slander, and invasion of privacy. The type of policy protects the insured in the event of a lawsuit. The dollar limit of the original policy has been exhausted. So, for example, our homeowners automobile insurance usually provides maximum liability coverage of $500,000 per occurrence. So when this is exhausted, your personal excess liability kicks in. So we recommend that you purchase a minimum of 1 time your net worth. 1 times your net worth. But usually we recommend that you purchase more than that because you can be sued against your future earnings potential. I'll share a story with you. A couple had recently purchased a $10 million, and this is a true story, recently purchased a $10 million personal excess liability policy. They were in an accident where they were determined to be at fault. There were 6 passengers and the 2 other vehicles involved in the accident. The property damage, medical bills, lost wages of passengers in the other vehicles exceeded $500,000. This exhausted the couple's automobile policy liability limits. Resulting litigation led to over $100,000 in expenses and $5 million in damages, all covered by their personal excess liability. Keep in mind, this coverage is really inexpensive, the amount of peace of mind you get.
So let's actually talk, we already did the poll. So let's actually talk about those of you that answered correctly. So those of you that said 30% of becoming disabled before age 67, you were right. Really, what is this all about? We want to make sure that you're protected when we look at disability. If you're going to have any lost time of missing work due to illness or some type of injury, you don't want that illness or injury to put your savings goals at risk. And what we mean by that is, what if you're out of work for a period of time and now you can't save for college education, or you cannot have enough for retirement. You don't want to actually miss out on some of those opportunities. Also, Dana had mentioned a little bit about some of the changes that we're starting to see with COVID. We don't know what some of those long-lasting effects are going to be and how that could affect somebody's health down the road, and if that would make you disabled in some capacity. So that's also something that you should be thinking about. And if you haven't looked into disability, this also could be a very good time. I'm going to actually give you an example of somebody that really could have used disability. Now, this is an extreme, I know, but some of you may have heard of Alex Smith. He actually is the quarterback for the Washington Redskins. A couple years back, he was injured and he's gone through, I want to say something like 17 different surgeries on his leg. Young, pretty young guy, family. They really rely on his income for their survival. And I know that they make a lot, but when you're not planning for something like that, it could be devastating. Luckily, he has come back to the game, but there could have been a period of time, or he may not be able to stay in as long as he normally would have due to that injury. Also, when we take a look at surgeons might be another good example. Or somebody that works with their hands, if you're doing some type of construction. When we actually look at that, if all of a sudden you are a surgeon and you hurt your hand and you no longer can perform those surgeries, what are you going to do? You might want to look at some type of disability coverage for yourself and your family. Next slide. So let's actually talk about the different types of disability insurance. So really, we're looking at two different ways that you can go about it. One is through your group insurance, which is typically through work. Couple of things to note about this. That is usually the cheapest way that you can get disability insurance. The coverage is pretty good. Downside is that if you leave your employer, then you could potentially be looking at not having that coverage anymore. Something else to take note, what if you would go on disability under this type of insurance, then those benefits are coming to you at their tax, so at a reduced rate. That's why sometimes you may want to actually go out and do a little shopping and find an individual plan, maybe to even help some additional coverage. So if you ever had a gap in employment or you needed a little bit more, then you have another plan that's usually pretty inexpensive that's going to help cover you through some through that period of time before you maybe reach retirement age. Also to note, those benefits are not taxable. So I think that that's pretty important piece to know. When you're looking at overall disability coverage, you're basically looking at somewhere between 60 to 65% of what your W-2 compensation is today. And it's going to cost you somewhere between 1 and 3% of your annual income. Also, ways that you could reduce some of the cost for disability is extend your waiting period. So you may say, instead of going on disability 30 days once I'm disabled, you may choose that to be 3 or 6 months down the road and have enough cash that's been put aside in case something happens. Also, you want to look at different options within those insurance policies, such as a COLA or a cost of living adjustment. So for example, let's just say that I go on disability today and my payment is $1,000. Well, if I'm going to be on disability for the next 10 years, my buying power today of 1,000 is not my buying power 10 years from now of 1,000. I would want to make sure that I'm adjusting for inflation. And that's what a COLA or cost of living adjustment rider will provide for you. You might also want to look at own occupation insurance coverage or rider. And it's kind of going back to that surgeon. Let's just say that they find that they've hurt their hand, they can no longer perform surgery. The insurance company very well could come back and say, well, you're still healthy in all other respects. You can still be a doctor, but you might say, but I can't be a surgeon. It's going to cover you for a very specific type of job that you are doing now and help make sure that you can get through that, or at least cover a gap where you might have to reskill yourself into another area. So we're going to pause there for just a minute. We have a couple of questions that have come in. So let's actually look at those. Dana, I think this one may be for you. How diligent do we need to be in recording our home assets? So furniture, jewelry, valuables, in order to make a claim to the insurance company. How important are keeping receipts and taking a record or video tour of the house?
I don't know the exact answer to that question. What I don't believe that I don't believe that you have to be that specific, but it's a great idea to be specific. Make sure you get reimbursed the actual, replacement cost. So with TVs, they say, put all your electronics, take pictures of it, and take pictures of the serial numbers, so that you'll actually be reimbursed for the replacement cost. I always tell my clients to video. Walk around your house, video every room, so they can see what's in the room, okay? The type of furniture that you have. Get behind your computer and document that serial number. So, but I have heard that you don't have to be specific, but it's a great idea to be specific. And then obviously keep that videotape or the, whatever however, if you record it on paper, keep it in a fireproof, waterproof lockbox.
Yeah, and I know that receipts sometimes can also be very helpful, especially if there's any jewelry that's been involved or like an appraisal that you want to go on here.
For jewelry, you really have to have the appraisals. That's for sure. Same with coin collections and art, really high value items.
Definitely. We also have another question. What part of your net worth is not exposed to liability claims?
Your home is not. Typically, your retirement plans are not. But that varies. Like your IRAs are like your 401k retirement, your qualified retirement plans. And IRAs, that varies by state, whether or not they are protected from creditor. You'd have to know like laws within your state on that.
Yeah, so I mean, just to maybe reiterate some of the points that Dana had made on that is when you're looking at being exposed, if somebody would sue you, really have somebody sit down and take a picture of your overall net worth, look at all of your holdings, retirement investments, what kind of vehicles they're in, whether it's an IRA, a 401k, an annuity potentially, personal assets, cars, second homes, because somebody still could find a way to look at trying to claim some type of those assets, especially if they see dollar signs, right? So you just want to make sure that you do a full review, take a good look at your snapshot of your net worth. And I think as planners, we also want to say, what's the worst case scenario that could happen? And when we're looking at insurance, keep in mind that this particular coverage, as far as umbrella, is fairly inexpensive. So it's well worth it, even if you go a little bit above. That gives you a cushion as you continue to accumulate your assets, just as the future goes on. But again, you're always going to want to review. All right, I think we're going to move on. I think we have another poll. We love our polls. So let's take a look at the next question. What percent of adult women do you think do not have life insurance? So we'll give you all a few seconds to answer that question. And the reason we answer that question, and we'll say that some of this is also applies to when we look at families, sometimes you have one person that's working and one person that stays home with the kids. And we're going to talk a little bit more about that. All right, let's see what you all have answered. All right, so 22% said 8, 43 at 31, 66 at 42, and 80 at 19. So let's actually see what the real number is. And Dana, I'm going to let you talk more about life insurance.
Okay. So 33% of adult women do not have life insurance, but 70% believe it's important. Why do you think that is? You know, maybe it's one of those things that we just keep moving to the back burner. We're too busy with our day-to-day lives to take care of that. Something that I see often is that when one spouse leaves the workforce to care for their children, the couple does not think that they need insurance on the spouse who stays home. That could be a big mistake. Think of the cost of childcare and house cleaning and so much more that would have to happen to enable that surviving spouse to continue to work. Often I hear people say that they have life insurance through their employer. And I think that's great. But keep in mind, typically an insufficient amount of coverage, you may lose that coverage if you leave your employer. So let's look at the next slide. On the next slide, you can see that women generally outlive men by several years. But they can also be widowed for 10, 20, even as long as 30 years. If your decision to purchase insurance or review, this sounds like a commercial, but I just have to keep repeating it. If your decision to purchase insurance or review your existing coverage is something you keep moving to the back burner, think about your values, what's really important to you. What would happen in the event of your premature death? Everyone has to have their life insurance needs and coverage reviewed periodically. Do you have the right amount? Do you have the right type? Is it the right company for you? Have your needs changed over time? Trust me, it will. Your wealth advisor is there to help you. More importantly, to help you avoid making costly mistakes. Now, let's talk about different types of insurance. So here's on this slide, and we'll cover this a little more when we talk about the different types. On this slide, you're seeing, why do we need insurance? What are the things we need to protect? Now, on the next slide, we'll go to, we're going to talk about term versus permanent, right? Those are the two main, two broad categories of life insurance. Term is basically as-you-go type coverage, right? You pay the annual premium, death benefit stays in force for 1 year, and then it renews each time you pay the premium again. Now, you can buy guaranteed level premium term policies where the premium is guaranteed to remain level for 10, 15, 20, 25, even 30 years. You buy the specific term that matches the period of time that you're going to need that coverage for. So no matter what happens to the cost of life insurance during that time period, your premiums will remain the same. So if you need life insurance to protect your earnings, we purchase a term policy with a level term period that matches your remaining working years. You might also buy term to cover the cost, cover a funding goal, maybe the cost of college education for your children until you're able to fully fund on your own. So what we often do is layer policies, align coverage with multiple goals. Insurance is inexpensive when you're young and healthy. Think about it. In your early life, your assets are low, and your need for life insurance is typically really high, so term's a great option. Now, let's talk about cash value or permanent coverage. There's so many different types of cash value type policies. They provide a death benefit along with a savings component. Right? And of course, you're going to pay a higher premium. But it's a policy that's meant to remain in force your entire life. Cash value is there to keep the cost of coverage level, not have it spike in later years when mortality costs could be significant. Why do we need permanent coverage? Estate liquidity. Maybe there's a family business transition. Maybe it's not a family business. There's partners in a business. Legacy planning, charitable giving. A lot of people buy life insurance policies and name a charitable organization as the primary beneficiary. There's lots of reasons to consider permanent insurance. Now, here are some important things to consider right now, though. If you have universal life or dividend paying policies where the premium was determined based on a particular interest rate or dividend projections that were in force at the time that you purchased the policy, you're going to have to review them right now on an ongoing basis. Interest rates have dropped significantly over the last several years, forcing insurance companies to decrease their interest rates and dividends. As a result, your policy may no longer be performing as originally expected. Don't wait. Sticker shock is only going to get worse. I'm going to give you a great example. I have a good friend I just talked to last week. He owns a life insurance policy with a chip company, and he was paying $10,000 in annual premiums that were supposed to end 3 years ago. In 2020, his most recent premium was $26,000, and he does not think that's going to be the end of it. There's also a new question on policy applications, and I think Michelle already covered this. Applicants are now being asked if they've been diagnosed with COVID. That's going to be interesting to see what happens with underwriting in the future on this issue. So maybe this is a good time to consider buying what some insurers are calling starter insurance plan. Your children, your grandchildren, even your younger adult children. These policies have riders that allow you to increase the amount of coverage over time at specific intervals without proof of medical insurability. And then last, for those of you who have policies with significant cash value, where the contract actually offers favorable loan terms, you might want to count some of this cash value as part of your cash reserves or your fixed income allocation in your investment plan. Because today, interest rates on cash and cash type vehicles, fixed income, yields are very, very low. Okay. So it might be nice not to over allocate these investments and be able to count that cash value toward that.
Yeah, thanks, Dana. There is a lot to look at when you're looking at term and permanent. And as Dana mentioned, if you have a policy, especially on that permanent side, and you've had it for a long time, make sure you do review it, because a lot of those are costing people probably more than they should right now. And just working with some of our clients and some of our business partners, we found that we've been able to save clients quite a bit of money, and in some cases, even with a lot better coverage. So, take a look at what you have, and if you don't have it, maybe explore that. Dana, we do have a question. What is the benefit of investing in life insurance if you have no spouse or children? My only dependent is my father with dementia, but he has his own assets, and my brother is next, and hold on, I apologize, it's hard to see on my screen, is next in line to take care of him.
You might need life insurance if you need money, if something were to happen to you, is your father going to be taken care of? If your father has sufficient assets and your brother's next in line, maybe you don't need life insurance at all right now. Maybe, but if you're young, a family is, something that you're thinking about in the future, maybe you want to get life insurance to sort of have that, be able to buy it at a younger age and have that in place when, if you do consider doing that. But, not one to tell somebody they need insurance when they don't. So it all depends on your particular circumstances.
Yeah, and I think that that's key. When we sit down with folks, we really talk to them more about what their current circumstances are. We try to give them a projection of what they think might be coming. So we would want to explore all those. But to Dana's point, depending on where you are in your life cycle right now, if like me, if I were single at the age that I'm at, I probably would not need it. Based like in a situation like yours, if my parents had their own assets and I had no children, because I'm not planning on having any children at the age that I'm at right now. So it may not be needed.
Now, when we talk about long-term care, this is where you might want to consider insurance. We're going to talk about a hybrid type policy in life and long-term care. This would be something that you might want to consider, which we will get.
Yeah, so thanks. So when we actually take a look at long-term care, 52% of people turning age 65 at some point in their life is going to need long-term care. And 14% of those people are going to need it for longer than 5 years. So how likely is it that you will need it? Well, you're going to want to take a look at hereditary factors like longevity, family caregivers that might be able to come in and help you if you would need it, and even looking at your own personal preference for care. Personally, if I can try to find a way that my daughter doesn't have to take care of me when I'm old, I'd like to find a way to do that. So let me just give you an example of why you may need to consider it. In my personal example is about my grandmother. She lived with Alzheimer's and dementia for almost 10 years. We started seeing early onset and it just continued. As many of you know, it gets worse as time goes on. So she moved from an assisted living to kind of a full care to a full memory care. And during that period of time where there was a need for care and she wasn't doing too badly, my mom was supplementing a lot of that time. And it gets to be really hard on those caregivers, especially if they are also working or still have children at home. Let's take a look at the next slide. Yeah, so when we look at how much is long-term care, that coverage going to be, this just gives you an example based on 2017, the median for nursing home care was about $97,000 a year. And basically it's estimated that you're going to need in excess of $340 for the lifetime cost if somebody in your family has dementia or if you have that propensity to have dementia as well. So, long-term care may be something that you want to consider. Again, a lot depends on your personal situations and how you feel about it. In the old days, I would say that long-term care was pretty expensive. It's hard to even get now as far as some of the cost goes. And traditional long-term care is if you don't use it, it's been gone. But there's some really great plans out there now. They're kind of a hybrid model that offer life insurance with a long-term care rider or a critical care rider. And those actually give you a lot of flexibility, have the ability to help you take care of yourself in retirement or into if you need long-term care, and leave a death benefit if you would also need it. Next slide, please. So when we look at overall care, where are you going to get it? And I love this statistic. When you look at this, the average caregiver today is 49 years old, and they work outside the home. They are providing about 20 hours of work to help care for someone in their family or for an elderly person. And a lot of people I know are actually stuck in that like stand generation where they've got kids at home, working, and they're trying to take care of their parents. So they've got maybe a full-time job as an employee, a full-time job as a parent, and now a part to full-time job in taking care of a family member. So things that you would even want to think about is, are you likely to become a caregiver yourself, or do you think that you personally would end up needing that help from someone in your family? If the answer is yes, you might want to consider looking at that. Other things to look at, 65% of caregivers are female. I do want to point this out because it has a rippling effect, and it's because women will end up being taken out of the workforce more often. That actually affects retirement and how you do planning. And it could also leave you less time with children at home. So if you are caught in that SAN generation, you might not be able to go to your children's events, sporting events, because you're having to go take care of an elderly parent. So just some things to think about as you look at long-term care. And as we continue to age, medical technology is getting better. It is keeping us alive longer. On some aspects, that's great. On others, it just means that we've got to plan a little bit better. So actually, I'm going to turn it over to you, Dana, for the next slide that just helps take us home a little bit on this long-term care coverage.
Okay, so how are we going to get the most out of our coverage? Well, as Michelle said, we have traditional pay-as-you-go type policies. And then there's what we call these hybrid contracts. Hybrid contracts are life insurance or annuity contracts that have a long-term care component. So, for example, life insurance policy with a long-term care rider actually pays an acceleration of the death benefit the insured needs to access the policy for long-term care benefits. But if the insured does not need to access that policy for long-term care or only a partial amount, then the full or the partial amount of the death benefit remains in force. Now, traditional policies are under severe pressure right now. Unfortunately, insurance companies didn't price them right. They didn't know how to price them. So now they're going back to existing policyholders with premium increases. Most companies have approached their policyholders several times. Okay? Now, maybe it's time to consider all of your options. When you are getting approached by companies to pay a higher premium, you also have choices. You can reduce some of the policy benefits. Maybe you can take off the cost of living rider. But you might even want to consider whether you should or can replace your current policy, your current pay-as-you-go policy, with a hybrid type policy. I'm going to tell you, this is a really difficult decision. So consider some other policy features. Does your policy offer home care? Did you know that most people will need care in their home for several years before they actually go to a nursing home? Does your policy cover it? What about assisted living, adult daycare? What is respite care? It's a policy feature that enables the insured to be cared for in a facility on a temporary basis. The caregiver gets a break. So no matter what type of insurance you have, it's not something you buy once, stick it in a drawer, take it out when you need it. The next slide, I want you to see that it's important not to wait. While 14% of applicants in their 50s are denied long-term care insurance due to health issues, almost 45% of applicants in their 70s are denied long-term care insurance due to health issues. You know, I say that the best time to apply is in your mid-50s. With these new hybrid contracts, I might even look at it a little earlier.
Yeah, and Dana, we actually even have a couple questions around long-term care. So one person, and you touched on it, but it says, I bought it a long time ago, but I think there are better policies out there, but what about switching? Is it too costly? Any ideas?
Okay, we've done this a million times, and I'll tell you what the issue is. One is those traditional policies have a lot of bells and whistles and a lot of features that are replaceable. So one of the things is that even trying to replace that coverage, even with the increase in premium, the premium is still significantly less than what you could replace that contract for today. And it's stressful because you don't know if the insurance company is going to come back again in the future and try to increase those premiums. Now, there's certain laws around how often they can actually come back to increase those premiums, but they can still do it. So you're making decisions based on like the fact that it's not replaceable today. Also, you might not qualify for the hybrid type life insurance type policies. Those are actually what I consider to be the best. But difficult. You have to go through underwriting a life insurance policy. And if you're in your 70s, and that's what's happening. People bought these policies, these traditional pay-as-you-go policies in their 50s. Now they're in their 70s. They've owned them for a million years, and insurance companies are coming back with these premium increases. But these traditional policies, these hybrid policies, they either won't qualify, they're going to be way too expensive, or won't ever get anywhere near the benefit at the cost that they have with their current policy. That's what's really happening.
Yeah, and I think the key here is that have your advisor review that with you, send it back out, have it reevaluated, see what else is out there, and that way you're just coming from a very informed state on what you can do or should do. But I would say before you make any decisions, make sure that you do really look at it and get a comparison from a couple of people. Just so that you're shopping that you're not just going to one carrier or back to your carrier and they try to sell you just another policy and you find out later that it's not the right one. You really want to look at the whole picture based on your situation. And as time goes on, if you have bought a policy years ago and you're reevaluating it now, your situation could have changed where you may now really be able to self-insure. So it may not even be needed anymore, but that's an opportunity for a nice review. Dana, did you have another comment?
That's a really good point. When you work with us, what we're going to do, we're going to run long-term care what-if scenarios to see if you're able to self-insure. Now, when you're able to self-insure, you may still want that coverage, but we could cut a lot of policy features to reduce the premium to give you just that level of like reassurance or enable you to use it just for asset protection.
Yeah, thanks. So any other questions that the audience may have? We'll take them now. And if we don't have any, first we want to just thank everybody for joining us today. When you look at insurance, there is a lot to consider. We really touched on a lot of high-level pieces today. If you do need to get kind of into that nitty-gritty conversation, have that conversation with your advisor. Start asking some good questions and how it might be specific to you. Hopefully you were able to take a few things away today when you look at just comparing it to your values and goals, making sure that that is in alignment, looking at the different insurance strategies that are out there and how those may be applicable to you. And again, just make sure that you're seeking the right guidance from somebody that you trust and that can give you really a third-party opinion. And as we finish up, I know that we are at the hour, but we have a couple of last-minute questions that I'll just try to ask. What if the insurance company goes out of business? Sometimes that does happen. And what you might find is that those contracts sometimes get kind of repurchased by whoever might be taking over that new insurance company. Or you may all of a sudden find yourself where they're trying to buy, that new company's trying to buy them out or payout of some kind. Worst case scenario is that there is an issue of coverage. Dana, would you add anything to that?
Yeah, a lot of insurance companies, well-established insurance companies who got into the long-term care business now decided to get out of the long-term care business, but they're still going to service your existing contract. Not selling new policies, they've gotten out of the business, but your contract is still in force with them.
Yep. And then last question, and we'll close out for the day. What kind of due diligence needs to be done when selecting a company? So if you're doing it on your own, I would say certainly get the opinion of 2 or 3. See if they are telling you different things, or if you find commonalities. That's what you want to be looking for, that you don't have any huge outliers. But certainly, as we had recommended, if you do have a trusted advisor, ask them to take a look at it where they don't really have any skin in the game. And what I mean by that is it's not going to hit their pocketbook one way or the other, whether you take that insurance. You want to make sure that you are doing it for you and for the right reasons.
Yeah. Like with long-term care, for example, want to make sure that you're dealing with a company that has a really good reputation of paying claims. That's one thing. You want to look at the credit quality of the insurance company that you're working with. So those are just a few. Every insurance type of insurance might be different, but definitely those two things make a big difference.
Well, we just want to thank you again for attending our Wealth and Wellness series. Just to let you know, we have a couple still coming up. So if you look at our Medicare, that is going to be on September 23rd. We have our Social Security that will be here on October 7th. And then we also have one on sleep on October 29th. And I think that's actually right around the time that we have the time change. So it's a perfect time to talk about sleep. And especially with the new environment that we've been in, what I hear out there from many is that their sleep has certainly been affected as their schedules have changed. So anyway, we look forward to having you at our upcoming events, and thank you so much for your time today.
Thank you.